Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. I'm going to show you what I call a crude momentum run. This is taking place right now. I'll just narrate my entries and then come back and give you more details. So I'm looking to get long here because it's breaking out. I get long one contract, and what it's doing now is forming what I call a mini volume node. You can see volume building in the right-hand column here. And so I'm anticipating that this is going to keep running. So I'm just going to hold on to this and wait this out. And you can see it's going to go against us a little bit here. But I'm not panicking at this point because on the bid you can see that every time it dips down a little bit, we get a lot of contract stacking every time that bid is refreshed. And that the sellers are having a lot of trouble getting through there. So no matter how much they're selling here, 329 contracts and 521 at 63.72, they're not really able to push back down through that. And then you look at the tape over on the right-hand side, and you're going to start to see some bigger orders come through there. We get 126 contracts traded right below that 42. Now we have 131, right? And so I'm anticipating this thing to keep running. And I'm going to look for a place to put on a second contract. I'd like to do that once it forms a new mini volume node or it really takes off. So I'm scaling in and scaling out on this, basically working the trade. So it's still trying to go up, and we still have absorption on the bid, which is a good thing. You see, okay, hang on here. So I put on a second contract there. I'm up, $150. Now I'm looking for a place to take this second contract off. I like to take them off on a burst. So I just took it off. Now I'm holding on to my first contract. It starts to run again, going up to form a new mini volume node. If it comes back down a little ways, I like to put on another second contract, which I just did, and now I took it off. So I probably got 5 ticks out of that one. Now I'm going to look for kind of a final burst here to take off my final contract. And there we go. I like to take it off on the way up because crude moves so fast that if you don't do that, it's liable to come down and slip, 6 or 7 ticks on you before you know it. And so this trade is now done. It's over. Let's see. I think I'm going to replay this and go into a little bit more detail. So I'm going to replay the same video, same exact video over here, and just add some context. This is just prior to the breakout. We have a high of the day at 63.56, and what you see at 63.54 is that they stacked 370 contracts there on the bid, absorbing all the selling that's occurring. That's a good sign for a breakout. Now on the right-hand side of the tape, you see that big order for 109 contracts come through. We're waiting for a breakout here, and then boom, we get a flurry of buying, and you just see those buy orders come through. And now as they're trying to sell it down, you see over on the left, as it does come down, all of that selling is getting absorbed, right? So we just had 300 contracts flash there. You can see they absorbed 383 at 63.74. Now we go down. We keep absorbing, and that's a good thing. We want to see buyers still in the market and absorbing any selling, so that we know this isn't going to go too far against us. So right there at 63.72, they absorbed 521 contracts, and that's the reason that I'm not necessarily panicking. And I see 200 contracts stacked at 63.69. Now 329 contracts absorbed there. That's the reason I'm not panicking and jumping out of this right away just because it went against me, 6 or 7 ticks. I'm still waiting for those buyers to come in. And what I see is they are coming in. There's a big order for 126 contracts. I mentioned that before, 131 contracts. And now what I like to see in these cases is strong directional conviction and movement despite opposition. So what does that mean? Basically, you can see that sellers are also absorbing the buying, but we're still moving up, right? Like 390 contracts absorbed right there at 63.79. Now 500, but we still push right through it. We go right through it like it's nothing. Now that's a lot of contracts to absorb on crude. but they did it no problem. They went through it no problem. And so that kind of like strong directional movement despite opposition is really key, and that's one of the key things to differentiating kind of a fake out breakout from, you know, a true breakout or a momentum run. And so let's see here. Every time it ticks down, we still get absorption, and then we get more buyers coming in. And that's why I'm not, you know, rushing to close that thing out, because I can still see that buyers are interested. And now, yeah, I mentioned in the first play of this video that this trade is done here. So it's done. It's done because what it's going to do now is just basically fill in this volume profile. It's going to fill in all these bare areas, and it's just going to chop, and it's going to be ugly until it puts its volume in this area. And how do I know that? I don't, but experience tells me that that's what's going to happen, and that's what did happen, because it's happened over and over and over. The reason that happens is because a bunch of people want to get long, but they're too timid, or they're a little bit too slow in their reaction. They miss that initial move, and it happens so fast that they get left behind, and then they look at this as an opportunity to get long. Well, at this point, all the people that were initially long are exiting their positions, and so the late entries, all the late longs, are basically just providing liquidity for people to get out, rather than providing kind of that proactive or aggressive buying that's actually going to move price. And so I'm done with this trade, and I'm basically done for the day, because I've gotten what I wanted to out of the market, and I'm not gonna sit around and trade choppy range and lose money on it. Okay, so moving to the very next day, I'm gonna show you an example that didn't work out. It wouldn't be fair if I just showed you the good trades. So what we see is there's a big buyer order, there's a big market order that comes through to buy like 13 or 1400 contracts. If you slow this down and pause and rewind, you'll see it on the tape. And now what we see, if I put a stop in at 64.21, I like to put it in a couple ticks into the previous range. But what we see here is at 64.35 and 36, we have 2,500 contracts absorbed on the offer. There's somebody big up there that is basically capping this and doesn't want it to go any further. And then on the tape, you can see that we're getting some big orders. There's an 89 contract order, but we're just not getting a whole bunch of 100+ lot orders coming through. And so that's not a good thing for this trade. So you know, if I decide that I'm going to decide that it's not working out, I'm just going to go ahead and close it out without letting it go all the way down to my stop, because it's just not working. And there you can see it's done. I'm out. Okay, so I'm just going to play this losing trade once more here and add some more information. The reason that I like to scale in to these trades rather than putting on all my contracts at once is because my stop is 15 ticks below my entry point, right? So it's pretty far away. And if you put on, let's say, you put on 3 contracts all at once, well, you're front loading your risk. You're putting on 3 contracts before you know that the trade is going to work out. Whereas if you just put on one and then it doesn't work out, well, you can exit for a loss, but at least it's just a loss on one contract. And if it works in your favor, then you can go ahead and scale into that as it's working out. So it's a way of kind of managing risk on this trade. I don't do that with all trades, but for this particular type of trade and something that's so volatile like crude, that's kind of one of my risk mitigation strategies. So we'll just look at one final example here. I'm not going to narrate all the details of this one, but while it's playing, I'm just going to go ahead and add some more information that I think would be useful to trading this. The first thing is um, I, I only trade crude in the morning from about 6 a.m. Pacific Standard Time to 9:30, usually just to 9 o'clock. But that's typically the only time that you're going to expect to see significant movement like this. And then from about 6:30 a.m. to 7 or 7:15ish, crude tends to slow down a little bit because it's the initial balance of the ES, and I think a lot of traders are kind of trading both and switching back and forth depending on the volatility in each market and what's setting up at the time. Um, so typically these momentum runs are going to occur anywhere from 7:30ish until 9:30. But it's a good idea to watch the market before that so that you get an idea of how it's moving and who's in the market and if there's sufficient volume to actually move it in this way. And that's a key thing, that you have big players in the market. On days where it's just kind of meandering about, or you don't see any big orders coming through at any point, chances are you're not going to have a momentum run. You're going to be kind of sitting on your hands waiting for it. Um, and that brings me to my second point, which is this is best traded as one strategy in a portfolio of strategies. What you don't want to do is sit around all the time just looking for a momentum run to occur, because there's a tremendous number of head fakes on crude where it pokes out 5, 6, 7, 8, even 9 ticks above the high or low a day or above a range. And let's say it's poking out above, and then you get long, and then big sellers come in, or the buying just fizzles out and it dies and it comes right back down on you. And that can happen over and over and over again if you're not aware of kind of what's going on in the market, and if you're not aware that that's occurring. So it's good to say to yourself, okay, if this doesn't work out, once or twice in a row, then I'm not going to trade momentum runs for the rest of this session, unless you see something really exceptional that's obviously setting up and is obviously going to work out. But in a case where they're not setting up, if you don't have, if the market's just not moving that way, and there's no big players, then you're better off trading a different strategy. You're better off fading those breakouts, or scalping ranges, or doing whatever else you have in your kind of repertoire, but not just sitting there always looking for this one trade, because you'll get faked out way too much of the time. And then the other thing is, if you're trading crude, you really have to be aware of the inventory announcement, which typically comes out on Wednesdays at 7:30 a.m. Pacific Standard Time. That's the EIA crude oil inventory announcement. But the market tends to thin out, up to say 15 minutes before that. So the market's thin. Whatever algos there are, trading shut off, and then the announcement comes off, and then usually crude just goes berserk, and it's hard to tell which way it's going to go. But I should have said, if you want to track that, which you should put it on your calendar. Go to the EIA website. Don't just assume they're going to occur at 7:30 every Wednesday, because they don't. It depends on a holiday schedule when they actually release it. But the key thing is, I don't trade a momentum run with the inventory announcements. I have a separate and distinct strategy that I trade for inventory announcements. Now you could potentially trade this strategy for those inventory announcements, but in my experience, it's hard to do because the market's so volatile and unpredictable. And even if you are right directionally and you do see it breaking out, chances are you're going to get you're going to get slipped a lot of ticks on your entries and your exits, which just makes it really hard to be profitable. I also don't like. I'm not a big fan of trading the inventory announcement in kind of an unstructured manner. Like I said, I have a single strategy that I trade on it, and the reason for that is because how fast crude moves tends to turn you into an emotional trader. You really want to catch that huge swing, and it's exciting. It's like a roller coaster, so it's super fun to trade it. But the problem is that it's super risky, super dangerous, and by and large, you tend to lose money if you trade it in anything other than a very, very structured way. Okay, so that's pretty much all I have on this. This trade is going to take a little while to work out, I think. But I created this video because when I was researching how to scalp crude futures, I couldn't find much good information out there. I didn't find what I would consider any great videos on YouTube. There are for other markets, but I didn't really see any good videos of people using order flow to scalp crude. And when I Googled it and looked into it, really all I found were kind of very scammy sales websites looking to sell courses and the usual bullshit that you find. But nobody that was really demonstrating anything that was viable or anything that was valuable or educational. So I decided to put this together. Now I should tell you that crude isn't my main market. I currently trade the ES. I do trade crude whenever the volatility on the ES dries out. So when there's not enough volatility to be successful on the ES, trading how I do, then I shift over to crude and start looking for trades on crude. So I hope this was somewhat educational. If it was, then please like it or write a comment. I'll use the number of likes and comments as a guide to tell me if I should create more videos with perhaps different crude strategies or strategies for the ES, or just more related scalping videos for futures. I'm not trying to sell anything. I don't have anything to sell. Just trying to provide content and show other people what I've learned just by trial and error, and a lot of painful hours spent at the screen, and a lot of investment and anguish and dollars lost. So let me know if you like it.